Today we're looking at how to win big and lose small when trading. If you've ever struggled with managing losses or holding on to your profits, I'll share the key strategies you need to turn your trading around. When I first started trading, I thought picking the right stocks was all it took. But I quickly learned that even perfect-looking trades can go wrong, and losses can pile up fast. Trading isn't just about picking winners. It's also about managing those inevitable losses and not letting them get you down. But enough about me. Let me show you what you can start doing to win big and lose small. When you first start trading, it's easy to think that if a trade looks amazing on paper, it's basically a win already. You've done your homework, checked the charts, analyzed the indicators, and everything aligns perfectly. What could possibly go wrong? You're feeling like a genius. And then, bam, the market does its thing and your galaxy brain trade turns into a disaster. The stock market is brutal and even the best setups can fail. It's like following a recipe to make the perfect cake, only for it to fall flat as you take it out the oven. The market's unpredictable, and no amount of analysis will make it behave like you want it to. There is just so much unpredictability, you just never know. That's why even if everything screams success, the market can still flip you the bird and go in the opposite direction. And this is where traders often get stuck. They think, if everything lines up, it's a done deal. But unfortunately, that's not the reality. Losing trades are a part of the game, and getting used to that is actually one of the best things you can do for your trading career. Losses happen. All you can do is to embrace them and deal with them as they come. Let me share a little personal story to drive this home. I once took a trade that was looking chef's kiss perfect. Everything was lined up. The stock broke resistance. All the indicators were flashing green, and I was practically already celebrating. I jumped in thinking, this is it. I'm a trading wizard. Now everyone will know what a stud I really am. Fast forward a few hours, and the market did a complete 180, and I watched my perfect trade turn into a losing position. I cut the loss quickly and moved on. But man, was it frustrating. Everything pointed to success, but the market had other ideas. Even the best analysis can't guarantee a win. But here's the golden nugget. How you handle those losses is what differentiates the pros from the amateurs. If you let a loss knock your confidence or make you doubt your strategy, you're in for a rough ride. The minute you start making decisions based on emotion instead of logic, that's when things get messy. What successful traders know is this: losing is part of the process. The trick isn't avoiding losses altogether, it's about managing them. To do this, you can set your stop-loss levels and never risk more than a tiny chunk of your account on any single trade. This way, if a trade goes south, it won't destroy your entire portfolio. And when you manage those losses like a boss, even a losing streak won't wipe out all your hard-earned gains. Here's another pro tip that's been a game changer for me, and that's to keep a trading journal. Write down every trade, whether it's a win or a loss. I jot down, did I follow my plan? Did I stick to my risk management rules? What did I learn? Reflecting on this helps me see losses as lessons, not failures. And as you'll see in this video, I try not to pay a lot for those lessons. Over time, this shift in mindset keeps me disciplined and focused on the long game. So, here's the bottom line. Losses will happen, even with your best trades. But the key is not to avoid them. It's about making sure they're small, manageable, and don't mess up your entire account. When you accept that not every trade will work out, and you keep your risk in check, you're setting yourself up for success. In the end, trading isn't about winning every time. It's about sticking to your plan, managing risk, and not letting a single loss throw you off course. In trading, one of the most important concepts to grasp is asymmetrical risk-reward opportunities. This simply means that you're aiming to risk a small amount of your capital in exchange for the potential to make a much larger return. It's about ensuring that the upside is significantly greater than the downside, which is what gives you an edge over the long term. And a great rule of thumb for this is to aim for at least a 3-to-1 risk-to-reward ratio. Let me break it down. Imagine you risk $100 on a trade. If you have a 3-to-1 risk-to-reward ratio, your goal is to make $300 if the trade goes in your favor. The beauty of this approach is that even if you lose 3 trades in a row, you only need one successful trade to make back all those losses and more. That's the power of asymmetrical risk-reward opportunities. I remember when I first started trading, I didn't really pay enough attention to this. I'd set my stop losses and targets, but I wasn't fully conscious of how much I was risking versus the reward I was aiming for. And then I'd find myself in situations where a small loss would eat into my profits because my risk was too high compared to my potential return. Over time, I realized that having a 1-to-1 risk-to-reward ratio, where you're risking as much as you're hoping to gain, just wasn't enough. The trade-off wasn't favorable. But here's the thing. If you consistently aim for a 3-to-1 risk to reward, you don't need to win every trade to be profitable. In fact, you could lose more than half of your trades and still come out ahead. Let's say you win 40% of your trades, but your winners are 3 times bigger than your losers. In the long run, you'd still be profitable. That's the magic of aiming for those favorable risk-reward setups. Now, this doesn't mean you should just throw out any trade that doesn't meet the 3-to-1 criteria. Not every setup will fit perfectly into that mold, but you should always look for opportunities where the potential reward far outweighs the risk. And even if you can't always hit a perfect 3-to-1, aim to err on the side of higher rewards with reasonable risk. Here's another example to illustrate. Let's say you're trading a stock with a clear support level. You plan to buy the stock near that support, and you set your stop loss just below the support level. If the stock breaks through the support, you'll exit the trade with a small loss. But if the stock bounces off support, you might aim for a 3-to-1 reward, your target price being much higher than your stop loss. This is a trade with asymmetrical risk-reward because you're risking a smaller amount to potentially make a larger return. But remember, risk management is key. Even with a good setup, things don't always go as planned. So, having a stop loss in place to limit your downside is essential. If you're constantly risking too much in each trade, it won't matter how good your strategy is. You'll eventually run into a string of losses that can wipe out your account. A good way to implement this in your trading is to always plan your trades ahead of time. Before you enter a position, decide where your stop loss and take profit levels will be, and ensure that your reward is at least 3 times the amount you're risking. This kind of structure allows you to trade with confidence and discipline, knowing that your risk is controlled and your potential rewards are maximized. One of the toughest aspects of trading isn't the strategy or analysis. It's dealing with the psychological barriers that can derail your performance. 2 of the most common issues traders face are not taking profits when they should and holding on to losing trades in the hope that they'll bounce back. Both of these behaviors can harm your trading results, so understanding and overcoming them is crucial. Let's start with not taking profits. When you're in a trade and it's moving in your favor, it's tempting to hold on for just a little longer. You think the price could go even higher, and instead of taking the profit, you let the position run. But more often than not, that's when the market reverses and your profits vanish. This happens because of loss aversion, a psychological bias where you fear losing what you've gained more than the potential for further profits. This fear of missing out keeps you holding the trade, hoping it will continue upward. To tackle this, you need to get comfortable with taking profits at predetermined levels. Before entering a trade, set your target. Whether it's a 3-to-1 risk-to-reward ratio or another objective, and stick to it. If the market hits your target, take the profit and move on. The key is not to let emotions dictate your decisions. By taking profits consistently, you're reinforcing discipline and protecting your gains. On the flip side, there's the issue of holding on to losing trades, hoping they'll turn around. It's easy to fall into the trap of thinking that the market will come back in your favor, especially if you're close to your stop-loss level. But here's the reality. The longer you hold a losing trade, the bigger your loss becomes. This is often driven by the same loss aversion bias, where you don't want to admit you were wrong. The solution is simple. Cut your losses early. If the market moves against you and hits your stop-loss, don't second-guess it. Cut the loss and move on. Staying in a losing trade because you're hoping for a bounce back only increases the potential for greater losses. It's important to accept that some trades just won't work out, and that's okay. The goal is to minimize those losses so they don't eat into your profits. I've personally found that having clear exit rules is essential. Whether it's setting a stop loss, a profit target, or using a trailing stop to lock in gains as the price moves, these rules take emotion out of the equation. When you stick to your plan, it prevents you from making impulsive decisions based on fear or greed. In conclusion, overcoming psychological barriers like not taking profits and holding losing trades is crucial for long-term success in trading. By sticking to your predetermined profit targets and cutting losses when needed, you'll reduce the impact of emotions on your trades. This mindset will help you stay disciplined and focused on the bigger picture, ultimately leading to more consistent and profitable results. Now you can keep those losses small and your winners big. Now, if you are still unsure when to sell your losses, check out this video on how to know when it's time to sell your stocks. In that video, I dive into the crucial signs you need to watch for, so you can confidently decide when to exit your positions and protect your profits. It's packed with insights that can help you avoid holding onto stocks for too long or selling too early, which is key for long-term success. And I'll see you in the next video.